1. Definition of bank health. Bank health is a term that describes the financial and operational condition of a bank. This reflects the bank's ability to fulfill its financial obligations, manage risk, and achieve sustainable profitability. Good bank health is very important to maintain the stability of the financial system and give trust to customers and investors. 2. Bank health indicator. To assess the health of a bank, there are several key indicators. These indicators include capital adequacy ratio, CAR, non-performing loans, NPL, return on assets, ROA, return on equity, ROE, and liquidity ratio. Each of these indicators gives a different picture of the bank's performance and stability. 3. Capital adequacy ratio, CAR. Capital adequacy ratio, CAR, measures how much bank capital is available to absorb losses. CAR is important because it ensures that the bank has enough buffer in dealing with the risk of loss. This ratio is determined by international regulations, with the minimum standard usually set at 8%. 4. Non-performing loans, NPL. Non-performing loans, NPL, is a measure of the quality of loans owned by banks. NPL shows the percentage of loans that cannot be paid by the debtor after a certain period of time. A low NPL ratio indicates good risk management, while a high NPL can indicate a serious problem in the bank's loan portfolio. 5. Return on assets, ROA. Return on assets, ROA, measures the effectiveness of banks in using their assets to generate profits. A high ROA shows that banks can generate more profit from each unit of assets they own. It is important for investors to evaluate how efficient the bank is in managing the available resources. 6. Return on equity, ROE. Return on equity, ROE, is an indicator that shows the return on shareholders from the invested capital. The high ROE reflects good financial performance and the bank's ability to provide added value to investors. This can also attract new investors to invest. 7. Liquidity ratio. Liquidity ratio measures a bank's ability to fulfill its short-term obligations. This ratio is important to ensure that banks can deal with sudden withdrawals or other urgent liquidity needs. A good liquidity ratio shows that the bank has enough reserves to fulfill its financial commitments. 8. Risk management. Risk management is a key element in maintaining bank health. This process includes identification, analysis, and mitigation of risks that may affect bank performance. An effective bank in risk management will be able to avoid large losses and ensure stable operational continuity. 9. Asset quality. Asset quality is an important factor in bank health. Banks need to actively monitor and manage loan portfolios to reduce NPL risk. Provisions for problem loans must also be considered, where banks need to allocate sufficient reserves to cover potential losses from non-current loans. 10. Regulation and compliance. Compliance with regulations set by monetary authorities is very important in assessing the health of banks. Regulations such as Basel III aim to increase bank resilience to financial crises. Banks that comply with regulations tend to be more stable and trusted by customers, which has a positive impact on the reputation and market position of the bank. 11. The impact of bank health on the economy. Good bank health contributes significantly to the economy. Stable banks can provide credit to the business sector and the community, encouraging investment and consumption. Thus, bank health has a direct impact on economic growth, job creation, and price stability. 12. Product diversification. One of the strategies to improve bank health is to diversify products and services. By offering various types of products, such as loans, savings, and investments, banks can reduce the risk of concentration in one sector. Diversification A. Trust to customers and investors. 2. Bank health indicator. To assess the health of a bank, there are several key indicators. These indicators include capital adequacy ratio, CAR, non-performing loans, NPL, return on assets, ROA, return on equity, ROE, and liquidity ratio. Each of these indicators gives a different picture of the bank's performance and stability. 3. Capital adequacy ratio, CAR.